Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Welcome to a special retrospective edition of the Alpha Exchange, narrated by yours truly. I'm a big fan of consequential events in market history, as they provide a great opportunity to learn about the conditions under which asset prices can become unruly. Are there commonalities in these episodes that might allow us to develop a roadmap for why, how, and when they might occur? From a risk management perspective, what are the key lessons of vol events? In this context, it's difficult not to reflect on the nearly unmanageable unwind of long-term capital that occurred 25 years ago. Over the next 50 minutes or so, I set out to take you through some of this important event from my own perspective and along the way bring in insights shared by guests of our podcast. I do hope you enjoy it. If you are a New York Yankees fan, 1998 was a glorious year. A World Series sweep of the San Diego Padres capped off a season for the ages. Paul O'Neill, Tino Martinez, Bernie Williams, Derek Jeter, heck, Scott Brocious had nearly 100 RBIs. Winning an unheard of 114 regular season games, the Yankees would finish an astonishing 22 games ahead of the second-place Boston Red Sox. Including 11 postseason victories, the Bronx Bombers would win 125 games in the 98 season, an MLB record. David Cohn's perfect game would come a year later, but it was hard not to call this a perfect season for the Yanks. Across the pond, there was no such historic feat at the team level in Major League Baseball. The Braves did win the NL East on the back of remarkable pitching by Glavine and Maddox. The Astros easily won the NL Central, and there's no evidence they cheated in the process. They were far ahead of both Chicago and St. Louis by a combined 31 games. Yankee dominance in 1998 aside, it was, oddly, the Cubs and Cards that captivated fans that season. Sammy Sosa and Mark McGwire engaged in an epic pursuit of the single-season home run record of 61 long held by Roger Maris. Both would easily surpass him, with McGwire reaching 70 as Sosa had 65. What else happened in 1998? As our great United States racks up deficits as far as the eye can see in 2023, 25 years ago, under Bill Clinton as president, Robert Rubin as Treasury Secretary, and Alan Greenspan as chair of the Fed, the U.S. produced a budget surplus. If 114 wins for the Yankees and a combined 135 homers for Sosa and McGwire are serious statistical outliers, the 1998 budget surplus seems now like a 5 standard deviation event. Zooming out, the big picture stats for USA Inc. looked fantastic as 1998 came to a close. GDP growth was a shade below 4%. The unemployment rate was 4.4%, and the stock market sizzled. The S&P 500 roared to a 27% gain on the year. The CPI was just 1.6%. Heck, a pound of bacon, more than $7 today, was just $2.50. What was not to love? Now, while Ken Starr was keeping President Clinton busy arguing about what the definition of is, one would be forgiven for assuming that Greenspan and Rubin were living the high life in the closing weeks of 98. Perhaps experimenting with the just-launched online gizmo called Google, it would not be unreasonable to guess that these two learned gents might be looking for the best deal on a well-earned Caribbean vacation to cap off a most prosperous year of policymaking and banner year of budgeting. That seemingly safe assumption was a far cry from the reality of the latter days of 98 for the Fed chairman and Treasury Secretary. Those were, in fact, fraught and often frantic times for the duo. Buried beneath the aforementioned propitious stats one might encounter in reviewing 1998 is a most epic market disturbance. And 25 years later, it is this period in 1998 that serves as the source of the forthcoming retrospective on risk, the meltdown of long-term capital management. What I hope to do over the course of the discussion that follows is to bring to life the rise and fall of LTCM as expressed through previous guests of the Alpha Exchange. This is in no way meant to be complete or exhaustive. There is already a substantial body of case studies, academic papers, and such on this important topic. But I hope this perspective is one you find interesting. Because I myself have spent 3 decades in markets, many of my industry relationships have as well. And because I believe strongly in the words of philosopher George Santayana that those who fail to remember history are doomed to repeat it, I often ask guests who are market participants in 1998 to describe the experience from their vantage point. First, the episode in less than 250 words. Star bond arb guru spins out of Salomon Brothers in 1993, recruits an all-star team of traders, quants, and academicians. Fund raises a substantial amount of capital day one and puts it to work around the world, earning dizzying returns seemingly uncorrelated to the broad market. Fund is likely largest client of most sell-side desks across trading and financing who provide leverage on incredibly generous terms. After a blistering run, the fund returns 40% of its capital in 1997 to investors, amping up its leverage ratio substantially in the process. Russia defaults in the summer of 98, creating what is called a, quote, giant risk-off in the modern-day lexicon of markets. LTCM is caught short vol, correlation, and liquidity in every way imaginable. The fund drops $500 million on a single day in late August, almost 25 years ago. Margin calls on OTC derivatives balloon. The VIX reaches 45. The fund's desperate attempts to unwind its giant trades fail. So too do its efforts at raising fresh capital. The risk in the market becomes the portfolio itself, and it soon becomes clear that the creditors too are highly vulnerable. The Fed, viewing the risk as increasingly systemic, brokers a recap of the fund, cajoling its lenders to pony up fresh capital for a stake in the portfolio, allowing it to be unwound in an orderly fashion. Emerging from the wreckage is an investigation from Congress, a report from the CFTC, countless business school case studies, and a New York Times article by Michael Lewis entitled How the Eggheads Crack. At least 2 excellent books have been written on the subject of LTCM. In When Genius Failed, Roger Lowenstein provides a gripping narrative of the personalities that drove the fund to both spectacular success and great failure. Along the way, we peek inside the politics of the rescue, patched together by Bill McDonough, president of the New York Fed, who brought 14 banks with sometimes sharply competing interests together and raised almost $4 billion in the process. Inventing Money by Nicholas Dunbar is a more technical recounting of the unwind, along with a rich history lesson on the development of derivatives markets along the way. He teaches the reader a lot, including how a form of optionality was embedded in the Hammurabi Code. I have been pleased this year to welcome both Roger and Nick to the Alpha Exchange and encourage you to check out both episodes if you've not done so already. My interest in LTCM is driven by the lessons that I believe readily emerge from this monumental market accident. Imagine, for a moment, being a fundamental portfolio manager leading a long-only strategy at a large mutual fund circa the summer of 1998. To be sure, Greek letters do not make their way into your risk management protocol. Convergence trades are not a thing for you. Instead, you pick stocks using valuation metrics while hunting for good business models and management teams. By August of 98, the volatility of the stocks in your portfolio has suddenly tripled. Further, the stocks have become vastly more correlated, undoing any hope you had for risk reduction through diversification. You review and re-underwrite each of your investment theses. What went wrong? A surprise, an unwelcome change in Fed policy? Nope. The consumer stopped spending? Not at all. Spike in oil prices? A tax hike? A big series of earnings misses? No siree, Bob. In the markets business, the second-by-second flickering of prices makes for intense study, if not sport. Financial media is a publish-or-perish business. At times, it appears that nothing can satiate our industry's craving for uncovering the why of motion in market prices. There's always an explanation at the ready, a speech, a data release, an earnings report, a press conference. Observing the price action, the effect, we are inherently in search of the cause. Explanation of price change often becomes our primary undertaking. And for that long-only portfolio manager circa 1998, this attribution was hard to come by. He or she would have struggled to see any of the previously cited traditional sponsors of change in asset prices as meaningful. Instead, the tidal wave of risk that was unleashed was one originating within the market itself, derived from once profitable trades now run amok. LTCM is a story about endogenous risk, about how conditions in credit, in carry, in the regulatory regime can create the runway for the implementation of trades that become part of the fabric of the market's risk dynamic. So let's get into it, shall we? As mentioned, I've been very fortunate to engage with some highly accomplished investors and strategists in the nearly 5 years I've been hosting the Alpha Exchange. Let's review some of what these folks shared in the context of LTCM. Let's start with Veneer Bhansali, who is a longtime partner at PIMCO and now runs Longtail Alpha, a derivatives-focused fund delivering hedge fund-oriented convexity programs to investors. Veneer was at Salomon Brothers in 1998 in the same bond arb group that LTCM founder John Merriweather had launched in the mid-'80s at Sali. Veneer said this.
Obviously, there were a lot of copycat who had the same trades on. In those days, that was the bread and butter of essentially the liquidity sale trade, because the on the run versus off the run is essentially trying to harvest a few basis points of liquidity mispricing, or not mispricing, but liquidity premium, and then levering it multiple times.
Indeed, as Veneer points out, crowding was central to the LTCM event. It is often cited that large investment banks, revering and also observing their largest client, implemented similar relative value trades. What happens when a community of investors is exceedingly same way on a trade? When capital gets stuffed into a risk exposure, be it a swap spread, a risk arb position, a Danish mortgage, or a short straddle on the S&P, the clearing price will ultimately be impacted. As capital moves in, volatility can be suppressed. The incoming capital acts as a stabilizer, and that stability plays an important role in helping these trades accrue profits. And we should appreciate how pro-cyclical this process can be. When times are good, as they largely were from the start of LTCM until 1998, it becomes easier to implement and unwind large positions. Carry trades are largely working, spinning out profits that get restaked into the same benign financial system that paid them out in the first place. Each fund or bank's book gets larger in this process of credit expansion, but there's an underappreciation of the totality of same-way risk because individual firms are not sufficiently aware of how much overlap there is in risk exposures. Ultimately, crowding is a complicating factor in sizing. Crowding means that you cannot simply size a position based on your own risk-return objective. You need to consider who's alongside you and to what degree. Further, ideally, you'll want to learn the reaction function of investors to market movements. Do they add on losses, averaging down, or is there a tendency to cut risk quickly? In what scenarios do they become vulnerable? What are the stipulations in their ISDA credit support annexes around NAV thresholds and early terminations of trades? Their vulnerabilities may cause headaches for you, but how can you quantify them? Sadly, there's no robust global positioning report that provides a clean, comprehensive look on where and with whom risk lives. Reflecting on some of this, C-Corp co-founder Ray Iwanowski shared this.
And then LTCM, by then I was co-head of the quant business at Goldman Sachs Asset Management. We didn't have the difficulties that LTCM did, but that was a good case study and a lot of lessons. If you think about it, one is appreciating, again, having leveraged positions. What are risks that aren't captured by standard measures like volatility when you take a lot of leverage? And then having really sizable positions, especially OTC derivatives positions, where counterparties have some control over what happens to you. Sort of mistakes of assumptions that drove their process were learning experiences for all of those who would do it subsequently. And so you spend a lot more time thinking about tail risk, counterparty risk, margining risks, and things like that from that experience.
And Veneer Bhansali added this.
I knew at that time that something was going on. Little did I realize that this was the time of crowded trades, and everybody else had the same trades on that Salomon did. So not a surprise that the domino effect came into play, and pretty much everybody lost a lot of money, and ultimately that resulted in the demise of LTCM.
On an Alpha Exchange podcast, guest Rick Buchstaber, founder of Fabric IQ, characterized market vol episodes as ultimately being the result of investors needing to transact at a pace that exceeded the system's capacity to provide liquidity at the prevailing set of prices. I like that characterization. When the demand for liquidity exceeds its supply, discontinuities are sure to result. Think about the crash of '87, the quant quake of '07, the GFC, the flash crash of 2010, the VIX ETP meltdown of 2018, and of course, about the joint crash in both stock and bond markets in March of 2020. Markets work until they don't. And at the heart of LTCM's philosophy was that even at the astonishing notionals of their trades, there would always be ample liquidity to satisfy their efforts to reduce risk if they so desire. SocGen's head of U.S. interest rate strategy, Subhadra Rajappa, said this.
I think the LTCM crisis was formative for me in trying to understand how markets react. Started off in a benign fashion, if you remember, with the Asian crisis. And then before you know it, it went from Thailand to becoming the LTCM crisis in a very short amount of time. So it was definitely something that was very instructive on contagion and how quickly things can spread from one part of the world to the other.
So we should appreciate that speed matters a bunch in markets. Let's contemplate the Fed hiking cycle for a moment. 500 basis points in a year, one of the fastest on record. And as we record this, the VIX is at just 15. But there was a lot of market vol in 2022 as the Fed sought to expeditiously get back to neutral. Those 75 basis point moves were a lot for the market to absorb and had the VIX in the 30s for a period of time in 2022. I often reorder the old Mark Zuckerberg quote of move fast and break things to read move fast and things break to describe market risk. Modern markets, especially interwoven with complex derivative structures, counterparty linkages, and exposures that lurk in a shadow system, are vulnerable to sharp, sudden price adjustment. I suppose about now would be an appropriate time for me to repeat the oft-cited quote from Warren Buffett, "Only when the tide rolls out do you find out who's been swimming naked." Central to the trade construction protocol of LTCM was the notion that pricing relationships among related securities, while subject to some daily noise, were governed by boundaries. Maybe this is some version of relative value economic gravity. And while not precise in the same way that physics is, those relationships were pretty tidy, especially with LTCM policing them. After all, how far out of whack could the 29.5-year Treasury bond be from the 30-year? Here's how Alpha Exchange guest and CIO of Sonia Capital, Anna Raicheva, described this concept of convergence.
So there's another instance where, again, during the 90s, that experience was the LTCM crisis when, again, it was the models were used as a mean reversion type of models among securities with similar coupons and maturities. But when the Asian crisis hit and liquidity conditions deteriorated, all of a sudden, all these assumptions of the models did not hold. And because a lot of securities were owned in leverage, when the credit lines would start getting called, there was a lot of disruption when those securities were getting liquidated.
Here, this idea of mean reversion is introduced, a cornerstone of the convergence trade that so heavily comprised the arsenal of trades employed by long-term. To be sure, it is true that the residual risk in a long off-the-run, short on-the-run trade is so small that these two securities can only get out of line by so much. But therein lies the potential hazard. If we are using historical data, price, volatility, and correlation, to understand the relationships between two securities, are we introducing a vulnerability? I've often said that, quote, risk management suffers from a failure of the imagination. By using data and data alone to perform our what-if analysis, do we fail to sufficiently entertain wayward scenarios? Then CIO of Light Sky Capital, Ben Melkman, shared this.
Because at the end of the day, generally, theoretical practitioners or the modeled types are pricing securities over an observation of recent history. They tend not to have the ability or the inclination, or it tends not to be part of their process to think about, to use imagination. What if? How could that change in the future? And so when you have a game-defining moment, like a major political election, which theoretically can completely change financial policy and then therefore have big moves in asset prices, it's almost impossible that vol will take that into account.
Ben hits on a broadly consistent mistake in investor behavior, the tendency for over-extrapolation of the present. We ascribe too much weight to the here and now. In doing so, the tendency is mostly to forecast sameness. When the data we in the investment community consume so voraciously each day points consistently in one direction, the narrative becomes further entrenched, as do the trades built around said narrative. In this light, there's a paragraph from When Genius Failed that's relevant here, and I'd like to reread. After a blistering 57% return in 1996, LTCM was reflecting on its success. Roger Lowenstein writes, quote, "And they had done it with stunningly little volatility. Not once in 1996 did long-term suffer a monthly loss of 1%. To Hillebrand, Hagani, and Hawkins, the results proved convincingly that diversification worked. The fund's diverse trades were blending with symphonic perfection, like the independent dice or the random cards from a model by Merton. Quote, we can't get the risk high enough, the trader told a friend, as if awed by their own doctrine. This is a striking paragraph. We can't get the risk high enough. If you were Joe Cassano at AIG Financial Products selling subprime CDS in 2006, or one of the many hedge funds in London's Mayfair district scraping carry off the Euro-Swiss peg in 2015, or the cab driver buying the XIV in 2017, you may have said the same. Portfolio sizing that hinges on recently experienced volatility, especially during very benign times, can become dangerously out of step with the actual risk level assumed. The quiet, when it comes to markets, pushes us to engorge in trades that spin off immediate, consistent profits. In the process, do we miss the forest for the trees when it comes to the broader question of risk? And this brings us back again to price, which I tend to think a great deal about as not just a result, but also as a cause. To be sure, price gyrates as a consequence of investors moving fast. Vol and volume have proven well correlated. But price is perhaps more interestingly contemplated in its role as a cause. I can't help but regularly channel Soros in this context, who allegedly once said, quote, price is the only fundamental. Price outcomes yield success or failure, and in the process play a meaningful role in how our belief systems are established and then reinforced. As I said on an earlier podcast, I told you so, in markets is nearly always about price, whose movements allow us to connect the dots between cause and effect. There's always a thesis at the ready to be supported by price, up, down, sideways, or in circles. For me, as a young derivative salesperson in 1996 and 1997, the resumes, the sophistication, and most importantly, the results of LTCM made the story of success nearly self-evident. Rosenfeld, Hagani, Hawkins, Hillebrand, Scholes, and Merton, all brought together by Merriweather. These folks appeared simply to be in a different category. And clearly, the firm's principals believe that as well. It's difficult to think otherwise given just how unbelievably large the book was. Along with a giant, complex book was a significant focus on both the durability of capital and on the management of collateral. Let's not forget that the very name of the fund, long-term capital, reflected the nature of the money raised from investors. The firm was able to lock up capital for a lengthy period of time, giving their convergence trades plenty of time to succeed. They also secured aggressive collateral terms from the street, again, allowing the trades to work over time and preserving dry powder should they want to add. This idea of dry powder is a critical one and clearly much discussed within the firm. How big should we be is a question they must have entertained daily, as does any leveraged market participant. In thinking about this and adding his own experience trading through the LTCM event, Hollis Park founder and CIO Troy Dixon said this.
And that was the lesson that I learned in 1994. 1995 was pretty evidently that while you can amass this massive arsenal that should weather any storm, the market is more powerful at times than you can even imagine. And I think that's what we learned from LTCM. I still use that as a mechanism for risk management, even in my head today, is don't get too brave. Don't be too smart. The market can stay more irrational longer than I can stay solvent.
These mean reversion trades were not just in the fabled on-the-run, off-the-run U.S. Treasury complex. There was a giant series of exposures assumed in Europe as monetary union was sought and the euro was to become a common currency. These trades, by many counts, were spectacularly successful and were engineered by Victor Hagani, who ran the London office. Victor, who founded and is CIO of Elm Partners, reflected back on 1998, sharing this.
And related more specifically to the LTCM experience, I think that one of the observations that have come following that is that the more closely related two things are, then I think that the more fat-tailed is the risk that you get out of them. If you're just going long stocks, that there's certain volatility to the stocks, volatility moves around. Sometimes stocks are more or less risky than at other times.
This is a critical and fascinating point. If we use two highly related securities as an example, the 29.5 and 30-year Treasury bonds, market efficiency demands that these ultra-like instruments cannot stray in value by very much at all. If you're a leveraged hedge fund looking to make any kind of real money on a small pricing discrepancy, a fairly high amount of leverage is going to be necessary. And if, for some reason or another, you become stuck, forced to unwind this position, the price dislocation can exceed anything justified on economics alone. Your misfortune becomes the source of the pricing dislocation. Thus, think about the vol of this on-the-run, off-the-run trade as effectively zero, but with a giant fat tail that could materialize on an unwind event. This brings me back to something that Victor Agani said in the aftermath of the demise of LTCM. Reflecting on the manner in which the portfolio itself became a central risk factor in the market, he said, quote, "The hurricane is not more or less likely to hit because more hurricane insurance has been written. In the financial markets, this is not true. The more people write financial insurance, the more likely it is that a disaster will happen because the people who know you have sold the insurance can make it happen. So you have to monitor what other people are doing." So here we see the painful and all too late recognition that the presence of the trades in the market mattered. As he suggests, Mother Nature keeps no ledger of the trading in catastrophe bonds. But in markets, and especially in the summer of '98, the extent to which these various carry trades were subject to marks that demanded fresh and increasing collateral to support them became the topic of conversation across trading desks. One aspect of the downfall of LTCM that should be discussed is their foray into new strategies. The pure expertise among the founders and principals was in quantitative fixed income. And to be sure, they were giant players in these markets around the world. But as they and the copycat capital that came behind them put more and more money to work, the return opportunities got less attractive in the core businesses. Scouring the globe for new opportunities, they set upon adding both equity risk and volatility arbitrage trades to the portfolio. A brief few words on equity vol, a fascinating asset class and a topic that has been an area of focus on the Alpha Exchange podcast. As the VIX index turns 30 in 2023, we've seen levels as low as 9, as high as 83, and just about every price in between. The VIX is a shorthand for the cost of 1-month insurance for the S&P 500. Its time variation is the result of a lot of things: the business cycle and economy, the Fed, geopolitical uncertainty, elections, the latest CPI report. All the rage recently is the concept of zero DTE, the 0 days to expiration option. I want it, and I want it now, is the market's milieu. I can't help but wonder if the consumption of these ultra short-lived securities is just another version of watching an entire basketball game on YouTube in 7 minutes with highlights only, or in how we consume tweets in a couple of characters, in swipe left or swipe right, or in the Major League Baseball pitch clock. A study by Microsoft Canada found that over the period from 2000 to 2013, the average attention span decreased from 12 seconds to 8 seconds. For comparison, we are told, a goldfish has an attention span of 9 seconds. That can't be great. But back to equity vol. As mentioned, the zero DTE phenomenon has been all the rage. There are lots of different takes on who accounts for most of these trades, what exposures they assume in doing so, and what the resulting risks may be. While no study appears conclusive at this point, for good discussions on the topic, see Alpha Exchange podcasts with Nitin Saxena, head of U.S. Equity Derivative Strategy at B of A, and Rocky Fishman, founder of ASIM 500. In 1998, there weren't even monthly options, let alone weekly or daily ones. LTCM wouldn't have cared anyway. The fund's interest was not in the gamma-intensive zero DTE type of optionality, but in that non-Greek letter Greek called Vega. A very brief review of gamma versus vega is in order. Gamma, as alluded to, is a risk factor that dominates in very short-dated options. It measures the speed with which delta changes and, as such, captures how quickly an underlying stock hedge will need to be updated. To be short gamma exposes a delta-hedged short option position to a large swing in the underlying in either direction, up or down. Vega is very different. Reflecting the P&L experienced by a 1% change in implied volatility, it is much more meaningful in longer-dated options. Thinking that long-dated implied volatility on global equity indices was too high, LTCM became interested in selling Vega. Victor Hagani said this.
Mostly, when it came to long-term equity vol, we were selling at levels that we thought was not justified by the economic variability or the variability in earnings and dividends going out into the future, and making also adjustments for changes in discount rates as well. So there was an underlying idea that goes back to the Schiller work on excess equity volatility. That was an underlying idea there when we looked at vol.
There's an excellent chapter in When Genius Failed on the fund's foray into equity vol. Dubbed by an executive at Morgan Stanley as the, quote, central bank of volatility, LTCM took the view that its role in markets was to identify structural pricing discrepancies and supply risk-bearing capital where others either could not or would not. It did not expect these mispricings to magically disappear. These were long-dated and less liquid options in the 3 to 5 year maturity bucket. As alluded to, the risk characteristics for these Vega-intensive options are entirely different from the one-day bets popular today. LTCM sought to implement these trades and warehouse the risk, accruing profits over a much longer horizon. If, because of a shortfall of sellers, these long-dated options cost more than they theoretically should have, one could step in as a seller, hedge the directional risk through an underlying instrument like a futures contract, and over time, extract value. The important risk, Vega, subjected LTCM, for better or worse, to mark-to-market risk around the clearing price of long-dated equity index vol. At the vol book's peak, they were said to be short $40 to $80 million of Vega. Translating, this means that just a 5-point rise in implied vol exposed the strategy to $200 to $400 million of loss. Dave Rogers, CIO of RPO Investments, said this.
A lot of the biggest positions and some of the biggest losses that long-term capital incurred were in the equity derivatives markets. They had huge short volatility positions in the S&P, the Nikkei, and the Euro stocks, and the FTSE. 80 million plus of short Vega in the index options market. And I've often said since that if you just took away the equity derivatives losses, just said they didn't have any of those positions, they didn't have those losses, I think there's a chance that they might have been able to survive. That's how big they were and how concerned people were about those losses versus some of the other things that they had.
Dave's comments around the fear that investors had in being trapped in positions that overlapped with those held by long-term brings us back to the notion of the risk inherent in crowding. A vast majority of the exposure taken by LTCM was via OTC derivatives. In fixed income swaps and equity vol, even in risk arb and pairs trades, strategies implemented in the cash equity market but then moved into long-short equity swaps for margining purposes. There's no ledger for OTC derivatives. As such, the trades I was putting on with long-term and long-dated straddles on the S&P and DAX, in the Royal Dutch Shell spread, in risk arb swaps, all were evaluated by Lehman's credit department on a standalone basis. There wasn't a conversation that started with, but Dean, they've got to be at least this big with Goldman, Morgan, and Merrill. I'm reminded of a scene from a favorite movie released in 1998, Rounders. Matt Damon as Mike McDermott, the likable protagonist card player wanting to beat the best in Texas Hold'em. Ed Norton as Worm, his dear friend of malevolent influence. John Malkovich as Teddy KGB. Playing a hand blind on behalf of Judge Petrovsky, played by the late Martin Landau, McDermott is asked if this is a wise move, to which he quickly answers, it's plenty wise. We know what we're holding, and we know what you're holding. A great scene. And there's some underlying parallel here in markets and positioning. At some point for LTCM, Despite the devotion to secrecy and the substantial use of OTC derivatives, its positions were widely known in the marketplace. I will not forget even where I was sitting on the 6th floor of Lehman Brothers in the World Financial Center on August 31st, 1998. According to When Genius Failed, LTCM dropped $500 million on this day alone, and a substantial amount of it had to be mark-to-market losses due to the short equity Vega exposure. A VIX of 45 was, of course, exceedingly high, but it was the bid to long-dated implied vol that was so striking to me. 2-year listed options on the S&P were north of 40 implied. Typically, when the VIX breaches 40, the vol term structure will be extremely backwardated. Take the August 2011 debt ceiling. With the VIX reaching 48 in early August, 2-year S&P vol reached only 27. The fact that the August 1998 S&P vol term structure was so high and only slightly inverted speaks to the back-end bid that came from LTCM's giant short exposure. As it became clear that long-term was in trouble, a number of other market cross-currents emerged. Financial and economic risk usually overlap. Sometimes an economic shock can create market unrest. The reverse is also possible. The GFC brought about the Great Recession. In the case of the summer and the fall of 1998, Russia defaulted, a liquidity crisis ensued, and LTCM's outsized portfolio became the center of attention, and the spillover into the broader markets, especially the banks that enabled the growth of the portfolio, also became a front and center risk. As mentioned, the VIX went to 45 as the S&P experienced multiple days when it moved by more than 4%. Swap spreads spiraled higher, multi-standard deviation moves that were at the time without precedent. The Tellab Sienna deal completely collapsed, costing LTCM a few $100 million. And the broad repricing higher of risk premium pushed just about every deal spread wider. The mortgage basis rocketed higher. Spreads on share class trades that LTCM was active in, Unilever, Royal Dutch Shell, HSBC among them, reached all-time wides. Everything in the realm of risk pricing was wider, whether the exposure could be attached to LTCM or not. But there was certainly an additional premium assigned to those trades for which the market was convinced long-term had an especially large, stuck position. The rest is history. The Fed quarterbacks a recap of the fund, forcing its lenders to the table. With respect to diffusing the OTC derivatives bomb, it pretty much works. The positions are auctioned off in a reasonably orderly fashion. By the end of 98, the VIX is down to 20. 10-year swap spreads have retreated by 25 basis points. The MOVE index is substantially lower from its crisis high. But the losses taken by this once untouchable fund are enormous. Nearly $500 million in EM exposure, $300 million in equity pairs trades, and the two biggies, $1.6 billion in fixed income relative value and $1.3 billion in equity vol. The unfortunate episode spawned plenty of hand-wringing and congressional testimony. But of course, we know that just a decade later, in the fall of 2008, we'd really be dealing with multiple LTCMs in the market at one time. Lehman, AIG, Bank of America, Citi. It's somewhat comical, but also quite instructive that in late 2007, Treasury Secretary Hank Paulson thought he could draw on Bill McDonough's playbook and get the banks to backstop the SIV, or Structured Investment Vehicle problem, through an ill-fated structure called the MLEC, the Master Liquidity Enhancement Conduit. It would be easy to be critical of this gross miscalculation of both the severity and location of the financial problem. In this rescue plan, Paulson would have the very banks that were the source of the systemic risk and desperately in need of capital themselves be the source of the backstop capital. The plan was quickly realized to be a non-starter. For the Fed in 1998, however, the on-the-fly mutualization of risk successfully diffused the bomb. In March of 1999, Greenspan, Robert Rubin, and Larry Summers would grace the cover of Time magazine as, quote, the committee who saved the world. It certainly reminds me of the Business Week cover featuring Merriweather in 1994, captioned with, quote, the traitor. In finance, you probably don't want to be on the cover of a magazine. Just ask SBF. And in professional sports, you ought not to pursue stadium naming rights. Enron, Conseco, CMGI, heck, we should probably throw Citi Field in there after the series of bailouts the large institution required well past the peak of the GFC. And most recently, let's not forget FTX Arena. In 2001, shortly after the tragedy of 9/11, famous author Bob Woodward penned a fawning account of Greenspan in his book, quote, The Maestro. It turns out that also in October 2001, Barry Bonds would shatter McGwire's home run record, hitting 73 for the San Francisco Giants. Incredibly, Bonds was walked 177 times that year, leading to an unheard of slugging percentage of .863. All this for a player who was 37 years old and who had never hit 50 home runs in a single season beforehand. Are there parallels between the spectacular rise and fall of LTCM in finance and Bonds, Sosa, and McGwire in baseball? I tend to think so. First, I'd argue that credit growth and leverage in markets were the equivalent of steroids in baseball. These financial forces, in the words of Nick Dunbar, underpinned LTCM's success in literally inventing money. In those glorious years leading into 1998, the profits arguably came out of thin air, staggering sums of capital earned in a system that glided gracefully ever further into a sanguine equilibrium. And as in baseball's steroids era, the profits were not simply awarded the protagonists. Sure, the trio of Bonds, Sosa, and McGwire got the most press and glory, but the long ball became a phenomenon across the entire league. In 1995, there were less than 4,100 home runs hit in the majors. 5 years later, in 2000, there were nearly 5,700, a giant increase of just about 40%. Fans love home runs, and owners love fans. Players love money. Over this same time frame, average player salary doubled, and ballpark attendance soared. Leverage and credit growth are the steroids of financial markets, an enabler of ever-expanding book notionals. When a fund makes 59% in a single year, as LTCM printed in 1995, and then follows up with 57% in 1996, it probably should have been widely understood that tremendous leverage was utilized over the course of 2 years when there was minimal perturbation of the financial system. The seller of accident insurance is sure to do well when market outcomes are accident-free. Over the course of 1995 and 1996, swap spreads were exceptionally well-behaved, fluctuating by just 20 basis points. This near motionlessness is nirvana for carry trades. The quiet in markets and the limited P&L fluctuations that result scream for more gearing. Quote, we couldn't get the risk high enough. If baseball's steroid era was enabled by a look-the-other-way philosophy grounded in excitement and profits, so too was LTCM's spectacular growth. The sell side rented its balance sheet at remarkably thin levels. But since the notional sizes of the trades were so gigantic, the profits were irresistible. A credit officer receiving a call from a derivative salesperson competing for LTCM's sizable business knew the drill. Take it or leave it. Most all of the time, they took it. As in baseball during the steroid era, the profits were simply too difficult to walk away from. So let's bring this reflection to a close with some broad takeaways. As said earlier, this discussion has been hardly complete. There is so much to study here in great detail. Among the many aspects worthy of examination in the aftermath of LTCM included the regulation of OTC derivatives markets, the proper role of the central bank in dealing with market crisis episodes, the management of trade collateral and netting risk, mechanisms for trade clearing and margining, and how to more effectively monitor and quantify counterparty credit risk. And to be sure, these were hot topics in late 1998. But also to be sure, by late 2008, the financial system was far more dangerously exposed to systemic risk. Reflecting on the tendency for the market to confront crisis events, Fabric IQ founder Rick Bookstaber said this.
It's going to be different the next time around. It may have to do with credit, it may have to do with common issues, but it's going to hit us in different ways and probably hit us with innovations in the market that didn't even exist the last time around. If we look at 1987, it was portfolio insurance that hadn't existed until a year or two before. If we look at LTCM, there are these convergence trades and the ability to put on super high leverage. If you look at '08, obviously we had the whole alphabet soup of CDOs and everything else, and the play of rating agencies on that basis. So the world changes.
Indeed, if there's one constant in markets, it is change. But even as such is the case, in the words of Barry Knapp, also at Lehman with me in 1998 and now running Ironside's macroeconomics, it's never different this time. We do learn from experience, but these lessons can fade over time, leaving us susceptible to making the same errors again. For me, the lessons of LTCM are many, but probably best encapsulated by a few of my favorite sayings. First, to repeat the words of Victor Hagani, financial market insurance is not like hurricane insurance. While Mother Nature dictates the timing and severity of the next hurricane, the financial market equivalent may arrive endogenously, propelled by the forceful unwind of trades that enjoyed too much success for too long. Second, stock returns, like U.S. politics, are not normal. In the wake of its downfall, LTCM suggested it was the victim of a 100-year storm. Sure, the gapping out of swap spreads and of long-dated equity volatility would have registered as such in the context of a draw from a normal distribution with a specified level of historic volatility. But, of course, the toppling of this portfolio in the market was the very source of said flood. Markets can misbehave, sometimes badly. I like to say that market prices are a never-say-never business. When a trade is forcibly unwound, massive price adjustment is almost a sure thing. Chris Cole told us that, quote, volatility is an instrument of truth. It brings me back again to crowding, both in and out of trade structures. Capital crowded in to carry and liquidity providing strategies of all shapes and sizes in the years leading into 1998. It wasn't just the risk appetite of LTCM's principles that led to the implementation of these trades. It was the Solly-Barned ARB desk that remained a real presence in markets after Merriweather and company left. It was various other professional buy-side and sell-side investors. I have taken to characterize the Fed's real main mission as one actually outside of the dual mandate of growth and inflation, which it is nominally charged with fulfilling. The Fed, I like to say, is in the business of crowd control. Its job is essentially to manage the tail risks inherent in a vastly leveraged system populated by complex financial intermediaries. It's quite interesting to me that one can Google both the, quote, wisdom of crowds and the, quote, madness of crowds and find plenty on each subject. The latter is often cited as part of the famous book by Charles Mackay, Extraordinary Popular Delusions and the Madness of Crowds, a treatise on, among other topics, market bubbles. The wisdom of crowds, in somewhat direct contrast, purports that large groups of participants can often yield information, prediction, intelligence, and estimations superior to that of even highly informed expert individuals. Translating this to markets, one might suggest, for example, that a TIPS-derived break-even inflation metric is of greater value than a survey of Wall Street economists on where CPI is headed. In both the madness and wisdom of crowds, I see both derision and respect for market prices, which brings me to a third conclusion from the LTCM debacle. And that, in the words of Passport Capital founder John Burbank, is, quote, price is a liar. Price is well worth studying, but false signals abound. A price is simply where two counterparties manage to transact at a given point in time. Look no further than what VAR models told investors and regulators about risk in late 2006 as the VIX dipped below 10 and the IG-CDX touched down into the 20s. By late 2006, implied volatility on Bank of America stock options was 11. By late 2008, it was 190. For LTCM, the portfolio was sized to produce a targeted volatility. But what if the market waters are especially calm during which that targeting estimation is made? Further, what if your presence in the market is playing some role in this unusual tranquility? Now might be a good time to share Alan Greenspan's remarkable and ironic warning when providing testimony to the Senate Banking Committee in 2005. As credit growth was rampant, the housing bubble was in full sway, and large investment banks were geared more than 30-1. The most erudite Fed chair told us then that, quote, history has not dealt kindly with the aftermath of protracted periods of low risk premium. Amen to that. Lastly, let me bring in Mark Twain. The famous author warned us that, quote, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." I love this one. Overconfidence is a consistent theme in market blowups. It's hard to argue that the principles of LTCM were not wedded to the view that they could conquer markets through the math of their models. Included in the LTCM annual report is the following sentence, quote, "We are the ones who created the models, and we have used them on a grand scale." Call it hubris or call it conviction, but certainly there was a strong view that the models would be proven right and that the early signs that change was afoot in markets could be explained away, not requiring action. Voltaire told us that, quote, "Uncertainty is uncomfortable, but certainty is absurd." Hyman Minsky told us that, quote, "Success breeds a disregard for the possibility of failure." Well, it's hard to believe it's been 25 years since the implosion of long-term capital management. If you are 30 years old and have been in markets for almost a decade, you were just 5 when LTCM went down. If you are 40 now, with nearly 2 decades in markets, you were a high school sophomore in 1998. They say history is a foreign country. If this saying does hold water, then I say the history of financial market accidents is another planet. Our tendency to disregard events as they drift further into the rear view is a human tendency. I think reviewing these events is worthwhile. History doesn't repeat, but it does rhyme. With that, I believe I have used up enough of your time. I hope you found the perspective shared here by me directly and through Alpha Exchange guests interesting and useful. Market accidents like LTCM are difficult experiences. At the same time, they are bursting at the seams with valuable risk management, regulatory, and policymaking lessons. All right, until next time, I wish you all the best. Catch you later. You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.